Welcome back to the Deep Dive. Today, we are strapping in for a journey right into the engine room of institutional finance. We're talking about the exploding world of private credit. And this isn't just about debt. It's about a highly customized legal architecture that channels institutional billions into the European middle market.
That's exactly right. Private credit has really moved from being this niche alternative to a completely dominant asset class. And for sophisticated investors, pension funds, insurers, understanding how this money moves is absolutely critical.
So our deep dive today is going to be hyper-focused. We're looking at one key mechanism, the Luxembourg S.C.A. SICAV RAIF structure.
And how it enables direct lending across some very diverse geographies. We're talking Western Europe, the industrial core of the DACH region, and even high-growth Eastern Europe, specifically Poland.
The scale alone just tells you why this matters so much.
Yep.
Private credit assets under management they've absolutely rocketed. We were talking about an estimated $1.7 trillion globally in 2024.
And just to put that into perspective, that surge is almost a seven-fold increase since 2008. Back then, the total was only, $260 billion? A huge jump.
And Europe is right at the center of this.
Oh, absolutely central to the expansion. The continent accounts for roughly 430 billion euros of that total. And Luxembourg is, it's the undisputed financial hub for these cross-border private fund structures. It's become the optimal legal platform.
Okay, so let's unpack this. This dense, complex legal architecture. S.C.A. SICAV RAIF. It just sounds like an alphabet soup designed to intimidate someone.
It does, but it's actually a brilliant piece of regulatory engineering. It's a very purposeful blend of corporate governance and operational flexibility, which is exactly what large regulated investors demand.
So let's break it down. What does each element contribute?
Let's tackle them one by one, and let's focus on their function, not just the name.
Okay, start with the foundation, the S.C.A.
Right, we begin with the S.C.A., the Société en commandite par action. So this translates to a partnership limited by shares. Its unique value is that it provides the structure of a familiar corporate entity. It's incorporated under Luxembourg law, it has a board of directors, a general meeting.
Why is that so vital, that formal incorporated board structure? For these institutional investors, couldn't they just use a simpler partnership?
They could, but for regulated institutions like, say, a large German insurance company or a Dutch pension fund, the S.C.A. structure offers this crucial layer of fiduciary security. They much prefer dealing with a corporate entity that has established internal governance, director accountability. It's just a different world from a pure contractual partnership model like the SCSP, the special limited partnership.
So it's basically a governance shield.
Yeah.
But it still maintains the economics of a private fund.
Precisely. It allows the general partner, the fund manager, to get their carried interest while they maintain unlimited liability for the fund's management. This ensures interests are really tightly aligned with the limited partners. It's the best of both worlds, really.
Okay, next up is the SICAV, the Société d'Investissement à Capital Variable. That sounds like language from the mutual fund world. How does variable capital apply here to a closed-ended private debt fund?
It's all about operational fluidity. It's hugely valuable when you're managing hundreds of millions in commitments. The variable capital status ensures that the fund's share capital automatically mirrors its net asset value, its NAV.
So you don't have to do paperwork every time money moves?
Exactly. Private debt funds have multiple closings, co-investments, capital calls happening over years. This just means the fund can increase or decrease its capital without requiring formal, expensive, and really time-consuming notarial amendments every single time. It's a huge time and cost saver.
Makes sense. And then we wrap it all up with the RAIF, the Reserved Alternative Investment Fund.
Yes, the regulatory envelope.
The RAIF is the feature everyone talks about for speed. Tell us about that, and crucially, what's the regulatory trade-off?
The RAIF designation is key. It's reserved only for well-informed investors, professional money. Because of that, it doesn't require prior product authorization from the CSSF, which is the Luxembourg financial regulator, and that delivers tremendous speed to market. You can launch the fund much, much faster.
Wait a minute, though. If the CSSF isn't reviewing the product beforehand, aren't investors sacrificing some regulatory due diligence just for that speed? Where does the accountability lie?
That's a great question. And the answer is it lies with the external manager, the AIFM. The RAIF vehicle itself is fully compliant with AIFMD, the Alternative Investment Fund Managers Directive. So the management entity, the AIFM, must be fully authorized and regulated by the CSSF.
Ah, I see. So the regulator is scrutinizing the manager and their processes, not the individual fund product.
Exactly. It's an efficient division of labor, and that ensures investor protection and gives you those essential passporting rights, which, allow the fund to be marketed to professional investors across the entire EU. It's why RAIFs are now the dominant choice. We're talking almost two-thirds of all debt funds in Luxembourg.
So that perfect combination of speed, governance, and EU-wide access really sets the stage. Let's pivot from the legal wrapper to the actual deployment. What's the investment universe? What are they lending?
The core activity is direct lending. They are stepping firmly into the void that's been left by traditional banks. Banks are constrained by Basel capital requirements, internal risk controls, all of that. So these funds focus on mid-market companies and very often sponsor-backed assets. And they deploy a whole arsenal of debt facilities.
Okay, walk us through the menu of debt they use. Start with the least risky.
The foundation is always the senior secured term loan. These are your classic first lien facilities. They benefit from security or collateral over the company's core assets. Think inventory, intellectual property, receivables. It gives them the highest priority claim if there's a default. It's the cornerstone of downside protection.
So that's where it gets more sophisticated, right? Where the yields really jump is in the customized combinations.
Exactly. The unitranche loan is extremely popular. It merges senior debt risk and that higher-yielding mezzanine risk into one single loan tranche. For the borrower, it simplifies their capital stack. They only deal with one lender group. But for the fund, they get a blended higher margin.
And what about the debt that sits lower down the ladder, the higher yield, higher risk stuff?
That's where you find true mezzanine or second lien debt. It's subordinated to the senior facility, and because of that lower ranking, it provides a much higher yield. This debt also frequently includes PIK features. Payment in kind.
Okay, we need to nail down PIK. It's interest that rolls up instead of being paid in cash. Why do borrowers want that, and what's the risk for the lender?
The borrower loves it because it lets them conserve crucial operating cash during, say, heavy growth phases or after an acquisition. They defer the cash interest payment, and it's just added to the principal balance of the loan. For the lender, well, the return is theoretically higher, but they accept the risk that the ultimate repayment is contingent on the borrower's success long term.
And these funds are also providing liquidity to the sponsors themselves, using assets they already hold.
Yes, through NAV and hybrid loans. These are secured by the net asset value of the private equity or credit portfolios themselves. They offer private equity sponsors very flexible liquidity without forcing them to sell companies. And of course, they also provide standard revolving credit facilities, RCFs for day-to-day working capital.
Given all that complexity and the mid-market risk, what's the compensation for the institutional investors who fund this?
We're seeing attractive margins. Ticket sizes for a single loan can range from 20 million euros up to 250 million. On average, the margins on European direct lending are substantial. We're talking 450 to 800 basis points above a reference rate like Euribor. Plus, you have upfront arrangement fees. It's a significant income engine.
Let's talk about the map now, the where. The strategy seems to hinge on diversification across three complementary European ecosystems.
Yes, the fund managers are balancing different economic characteristics. First, you have the deep developed mid-market of Western Europe, France, Benelux, Spain, Italy. The focus there is on resilient defensive sectors, healthcare services, enterprise software, things with predictable revenue.
And then you move to the economic heartland, DACH.
The DACH region, Germany, Austria, Switzerland, is all about the middle stand. These are powerful, often family-owned, export-oriented industrial and tech companies. Private credit is essential here. It helps finance buyouts and, critically, solves complex succession planning issues. It offers tailored long-term capital.
And the third geography, Eastern Europe, with a focus on Poland. What makes Poland stand out?
Poland is the growth accelerator. It has these robust, high-growth sectors in manufacturing, logistics, IT, and importantly, the private lenders are filling a very clear funding gap. Local banks in the region often face constraints. They might lack the expertise to structure these complex facilities, so the fund steps in.
So we know the where, who is the who. What's the profile of the company they actually want to lend to?
The sweet spot is mid-market corporates. EBITDA generally between 5 and 75 million euros. The key criteria are resilience and cash flow predictability. So they're looking for B2B services, food logistics, specialty manufacturing, businesses with strong cash conversion.
Let's ground this with some examples from the source material. It really helps illustrate the fit.
Okay, take Western Europe. A representative deal was a €120 million unitranche facility for a sponsor-backed French healthcare services platform. The appeal there was the defensive, non-cyclical nature of healthcare demand. It underpins cash flow reliability.
And for the German industrial core.
For a German middle-stand technology manufacturer, the fund structured a combination package. A senior secured term loan for the long-term CapEx, paired with a flexible revolving credit facility for working capital. The covenants there were highly tailored to the company's specific order patterns.
And finally, the Polish example. This really underscores that growth and gap-filling mandate.
That was a €60 million senior secured loan to a Polish logistics operator. It was earmarked for developing new, energy-efficient warehousing for the booming e-commerce sector. And that deal was particularly interesting because it included ESG-linked pricing, so the interest rate would drop if the operator met certain sustainability targets.
That's fascinating. That detail really brings the strategy to life. Okay, let's reverse the view. Let's focus on the institutional investor, the one writing the multi-million euro checks. Beyond the yield, what are the primary benefits for them?
Well, besides those mid to high single-digit net returns, the resilience against inflation is a massive benefit. These loans are structured with floating rates, so as central banks hike reference rates, the coupon income automatically resets. It allows the returns to generally keep pace with inflation, protecting the real value of the capital.
You've stressed downside protection a few times. How is that managed beyond just being secured debt? What ensures they don't lose that capital?
Downside protection is built right into the investment process itself. It starts with conservative structuring, but the real defense is in the details. Financial covenants. These are maintenance tests, leverage limits, debt service coverage ratios. That must be met quarterly. If a company breaches a covenant, it triggers an early warning signal. It allows the lender to intervene long before a full default occurs.
That brings us to the risk management process. The source material outlines a rigorous 6-step process. But that final step, monitoring, that's where the rubber hits the road.
Yes, the post-investment monitoring phase is arguably the most demanding. It's continuous. The investment team gets quarterly financials, they have management calls, they run constant covenant tests. They look for specific early warning indicators, like a sustained drop in the debt service coverage ratio, for example.
And what happens when an indicator flashes red?
This is where direct lending is so different from syndicated debt. The fund holds the entire facility so they can react immediately. If a covenant is breached, the fund can restrict further borrowing, impose new restrictions, or negotiate a remedial plan, like forcing an equity injection from the sponsor. That proactive engagement really mitigates the potential for loss.
We briefly contrasted the S.C.A. with the SCSP earlier. Let's circle back to that institutional preference. Why is that board-driven incorporated S.C.A. structure so often mandated now by these big LPs?
For certain large regulated investors, their own internal governance mandates simply require the fund to be a corporate entity with legal personality. They need a formalized board structure with independent directors to fulfill their own fiduciary duties. The SCSP is more flexible, but it provides less governance formality. The S.C.A. is chosen because it satisfies the most stringent regulatory requirements.
That level of governance clarity makes sense. So what's the final calculus for the investor, the well-informed professional committing capital here?
For them, this strategy provides consistent, high-quality floating rate income and diversification. The returns have a low correlation to listed markets. It acts as a perfect stability buffer alongside higher beta private equity allocations.
But there's a major trade-off. We need to be clear about that barrier to entry.
Absolutely. The returns compensate you for complexity and, most significantly, for illiquidity. The investment horizon is long. It's typically a 7 to 10-year term. Once that capital is locked up, it is generally illiquid for the life of the fund. Investors must be prepared to commit that capital for the long haul.
That lockup is the price you pay for the illiquidity premium. So we've covered the growth, the optimized legal structure, the debt instruments, and the rigorous risk management.
The key takeaway is really recognizing this S.C.A, SICAV, or RAIF structure as the most efficient vehicle for channeling deep institutional capital into tailored lending across these dynamic European markets.
And here's a final provocative thought for you to chew on. Given the critical role this private credit now plays in financing essential European sectors, like healthcare and logistics, where banks are constrained, how might increased regulatory scrutiny on the borrowers themselves, maybe related to ESG compliance or antitrust, how might that impact the documented downside protection provided by these customized financial covenants? The ultimate risk is always changing in the political landscape.